Hey, I decided to take a machine on lease to my company. Okay. Did you check out with any leasing companies? Yes, I checked with Flex. They agreed to give me the lease for 5 years at 11% interest. The rate isn't bad. What was the repayment coming in? Well, I need to pay 10,000 each year, but there was a issue. What was that? They have a minimum lease period of 5 years, but I own the lease only for 3 years. I'm sure you can speak to them and look for an early settlement. You may have to pay a early termination penalty, however. Yeah, I spoke to them. They asked me to pay 20,000 extra on the third year as a early termination fee. That sounds quite fair. I've lost touch on my accounts. Can you run me through how this would affect my accounts? Well, this is going to be treated according to IFRS 16 leases. Now, you need to initially recognize a lease liability and the right to use asset. Right to use asset? What's that now? See, when you buy an asset on lease, you don't really own the asset. You only get a right to use it. So we will not recognize the machine as an asset. Instead, we recognize a right to use asset. Oh, well, then that means I will have to depreciate that asset as well, isn't it? Correct. You will have to depreciate it over the lease term. Now, even though the original lease is for 5 years, since we are looking at an early termination, our lease term is going to be 3 years. So you will be depreciating this asset over 3-year period. Oh, okay. So how do we recognize the cost of this asset? Well, according to IFRS 16, when you look at the cost, you have any direct payment that was made and any initial payments made on or before the lease period, and then you will have the dismantling cost, and to this we would add the present value of all our lease payments, which we refer to as the lease liability. Lease liability? Is this the total annual payments I need to do? Other than for the annual payments, your lease liability is going to include any fixed payments to be paid over the lease, then any amounts expected to be paid under residual value guarantees. If we are going to purchase it, what price do we need to pay for the asset? And then in this situation, we do have a termination penalty. So that penalty of 20,000 would also be included in the lease liability. So I use the lease interest rate as my discount factor. Yes, correct. We would take the discount factor at the implicit interest rate of the lease. If it is not available, we would use the incremental borrowing rate. All right, I think I'm getting it. Could you show me how this affects my financial statements and the calculations? Sure. Let me grab my computer. Let's see how do we calculate the present value of these lease payments. So year 1, year 2 and year 3, we have a fixed payment of 10,000 each. But when it comes to the third year, since we are planning on terminating it earlier, we may have to pay a little bit of a premium. So let's say we paid about 20,000 extra. So we would have to pay 30,000 on the third year. Now we need to take the discount factor. Our implicit interest rate was 11%. So at 11%, the discount factors are going to be 0.901, 0.812, and 0.7. 731. So the present value is going to be to the discount factor. So we would use the same for the remaining 2 years as well. So then we can get the total of this. So the total of all of these payments is going to be the present value of your lease liability, which is 39,060. Right. So now we can move towards the right to use asset. Now the initial cost of it was around, let's say, 50,000 as you mentioned earlier. And then you may have to do some documentation and all of it. So let's say that you incur some cost of around 10,000 doing all of that. To this, you need to add the present value of the lease liability. So the present value of the lease liability is going to be 39,060. So you add all of these together, you will get the cost of your right to use asset, right? Now the depreciation on this asset, since we are to use it for about 3 years, our lease term is 3 years, right? My depreciation is going to be, I take my cost, which was 99,060, and my lease term is 3 years, So my depreciation would be 99,060 divided by 3, that will be 33,020 a year, right? So we have year 1, the balance in the first year would be 39,060, which was the balance we calculated at the present value of our lease liability. On this, we would calculate 11% interest. So 4,297 is going to be my interest. Now my repayment is going to be 10,000 each year. So my closing balance is going to be 39,060 plus the interest minus the repayment. So in the second year, the balance is going to be 33,357. Then I'll calculate my interest. My repayment is going to be 10,000 again. My closing balance will be 27,026. I come to my third year. 27,026 will be my opening balance. I would need to charge interest at 11%. Now my repayment here is going to be 30,000. So now when you look into the balance, your balance would be -1. Basically, it's almost 0. Okay. So the amounts that you see under the interest is what you'll be showing in your statement of profit or loss as your finance cost. Whereas the balances that you see as your closing balance is what you show in your statement of financial position as your lease liability.